Hey guys, Michael Ketchen here with another episode of the Michael Ketchen Show. You might notice a different setup out here in Arizona for the winter. I got out of the snow and I'm joined by a different co-host today, or a guest. I don't know which way we're going to go. Michael, Susi.
I'll take either.
I'll
take either.
Put a little pressure on Matt, right? Put a little pressure on Matt Hitchcock.
Yeah,
this on the number 2 seat here.
This is a question I didn't know I'd be getting right off the bat, but I'm happy to be here.
I'm happy to have you. So, Michael, or Mike Susi, I guess I still, in my mind, it's kind of funny. It's Mike Susi. We got together years ago when I was giving a keynote speech at a college that they probably regret asking me to come speak, but I was pretty raw and I was pretty real. And you reached out, we connected, and I've told people a little backstory real quick. I'm always so proud of you. I truly am. You came up afterwards, we met a couple weeks later. You said 2 things. You said, I want to get into real estate. True. And you said, I want to move to Phoenix, of all places. You might have said Scottsdale. I feel like I get the 2.
I think Phoenix.
Was it Phoenix? I think it was Phoenix.
I think generally Phoenix, but it is crazy. I'll let you continue, but yeah.
And so fast forward, I get you in touch with some people. You get into the lending space. You do a couple of deals. And then you called me. Was it 2 years in? How far in were you at that point?
Man, I don't know. Probably a year and a half, 2 years.
Year and a half. And you go, hey, I just want to let you know I'm moving to Phoenix. I've got an opportunity to expand my lending business, and I'm doing it. And you fucking did it.
Yeah, it is wild because to your point, I had gone back to Maine. I was born and raised in Maine. Just for context here, went to school at a small school in Boston.
Same one I went to.
The same that Mike went to. And I was
a little too fucking left-leaning nowadays. That's why I won't give them any money if you keep asking, just so you know.
I went up to Maine, and it was longer than that before I moved out to Arizona. But there was a period of time where I hadn't even really considered. I kind of wanted to get a base back in Maine, kind of learn the ropes of this business that I'm now in, which I'm sure we'll get into. Years later, it actually was about. I probably called you 3 years after, and maybe 3.5, 4 years that I moved out here. But there was a period of time where it wasn't even a consideration. And so the fact that you were the one that reminded me, hey, there was a period of time where you were going to move out to Phoenix, and for it to come full circle like that is kind of wild to think about.
And now we're sitting here. Now we're going to be doing a deal together.
And we are in Phoenix. So.
Yes. And literally that is the definition of bet on yourself. And that's why I wanted to kind of open with that story, because I remember, I think similar to me, correct me if I'm wrong, you were the first in your family to go to college, right?
No.
Oh, no, you were not. I thought you were the first.
No.
I remember it was first with that. You wanted a different non-traditional path. There was some training stuff. Yeah, it was entrepreneur. That's what it was.
Yes.
And you come out here, you get going on that. But for more about you, and we'll get into where people can get a hold of you after, that's great. One of the reasons I was excited to have you on is I feel like the opportunity everyone's been waiting for, if you will, is coming. The tide's going out. Deals are popping up left and right. We were just talking about some opportunities I have. On the lending side right now, what are you guys seeing? Is this a great time to buy? Is it a great time to lend? Are you guys kind of hunkering down? You don't think we're there yet? Are we at the bottom, at the top? What is Mike Susi's opinion of the macro and the micro market right now?
Yeah, that's loaded. So I'll start.
Very loaded. That's why there's a lot to unpack. It's a podcast, Michael.
Yeah, how much time do we have? I think I'll start with, is it a good time to lend or is it a good time to be active? I think it's always a good time to be active and on the principal side. Because, and it kind of depends on your approach too, but there's always going to be deals out there. Mm-hmm. I know you're an advocate of that.
Yeah.
You just have to know how to find them. And in some markets and in some circumstances, you need to know how to be creative. And I would definitely coin you as the king of creativeness when it comes to it. And so I think there's always an importance to have some sort of allocation of your investments and portfolios into kind of real assets in the real estate, or on the principal side. So I'll start with that. Now, on the debt side, I really like debt as an investment for a number of reasons, but you generally don't get all the tax benefits that you do to owning real estate. So I think it's nice to have a balance. But the reasons I like debt is if you know how to properly underwrite, or you're putting it with your money with somebody that knows how to properly underwrite, and you're lending on the appropriate collateral, it's a very safe investment and it's very consistent. And I think that those 2 factors are a really important allocation of anybody's portfolio, is the safe and consistent aspect of it. And generally it's a pretty favorable risk-adjusted return. So for the amount of risk you're taking and how well you're protected, the return you're getting is relatively high. In a lot of instances. And that, it depends on if you're putting it in a fund, if you're doing it yourself. I happen to do it myself, and we have a fund, which I'm invested in as well. And so there's a number of different approaches. So I guess that answers the first question. The macro and micro market, like debt as a whole, I think the private money space, which is the space that I operate in, there's tremendous opportunity right now because over the last year or two, banks have become really tight in their lending criteria and their parameters. And even for a period of time, there was definitely a feel that banks really, and still to some extent right now, banks didn't want to lend money. They were doing everything they could to say no for a myriad.
I'm going to jump in right there real quick because you just said something that not enough. I was just having the conversation today. Real estate investors think of. So I want to go deeper on the point because I don't want to jump ahead of it. I am amazed at how debt is such a critical component in real estate investing and how many investors have not taken the time to understand how lenders work. So back to the creativity that we use in our own portfolio, a lot of that comes from early on in our investing career. We had a deal go sideways with the bank. We were green. I mean, it was like our third deal. And I said, I'm never going to be in that position again. So I decided to learn and think like a lender. When you say banks weren't lending, it's such an interesting thing that went over a lot of people's heads because banks underwrite and look at risk differently, and there's different places for capital, which is where a private lender, which is probably should have clarified, where it comes in, there's different lending criteria. Mm-hmm. Can you expand on that a little bit?
Yeah, definitely. So how I would summarize it, and the difference between myself, a private lender, or I'd identify, let's just say, as a private lender, and what we do is hard money or private money. I use those interchangeably in some instances, versus a bank and the banking world comes down to what is being underwritten and how you're evaluating risk is how I would. So if I'm to put it in two buckets, you can evaluate the asset itself, the hard asset, and how it's performing and what it's worth, or you can evaluate the individual. Banks will largely, if you're to weight the two, largely underwrite the performance and the creditworthiness of the individual. And it's not to say they won't look at the asset. They still will. That's why you get an appraisal and all that good stuff. A private lender will put a lot more weight in the asset itself. So people also refer to it as asset-based lending because they're weighting the asset and the underwriting of the asset more than they are the creditworthiness of the borrower, and vice versa. We're still looking at the borrower. I want to make sure that they're not going to just not pay me from day one to some extent, but I do know I can sleep well at night knowing I'm well collateralized and that asset is really strong collateral for me. Yeah,
and that's something great to unpack, and there's a million other ways you can go down there, but if you go back when you listen, especially if you're getting into it, I feel like it's funny. People have asked us repeatedly, how'd you guys scale so much? How'd you keep so much equity in your deals? I said, well, buying really good deals and operating, and also getting relationships with private lenders and not being afraid of the rate on the spreadsheet. And I've never gone public with this, but I'll walk through it. And one thing that kills me, and you said it earlier, I do not think real estate investors, large in part, understand the relationship between debt and equity enough.
I agree.
Wealth is built, it's not built through cash flow. For all you people out there listening, I love cash flow. Cash flow is king. But wealth is not created through cash flow. Wealth is created through equity. Equity is ownership. So if I can get a deal that's good enough that can support more debt, it usually means I get to keep more equity. And then if I perform, I get more of the upside. So we've done some deals, and it makes me laugh. Like I'll walk through one deal just real quick with private money because I think this is going to shock everybody. And to be clear, Mike was not the lender on this, but it's private money deal. We found a lender that was comfortable to do a second position note to us. It was a private loan to us, so it served as equity for us. We paid 24% on over $1 million. We bought the asset. We generated over $3 million in forced appreciation in about a year. So we paid 24%, whereas if we brought in investors, it probably would have been 7-8% pref, and then a probably 70-30 split. And there's deals for that. But we would have gave away 70% of a $3 million upside because we would have been afraid of the rate, right? And it goes back to what I said in the beginning. A really good deal and understanding the operations, understanding the execution, but keeping all that upside. So do you find a lot of investors, I kind of get some sticker shock sometimes at the rate on the private lending side?
Yeah, absolutely. And I think it varies too from residential to commercial and the size of the operator because, and this isn't always the case, fortunately or unfortunately, as you go up in kind of deal size, the level of sophistication will generally increase. And with that level of sophistication, it's all numbers on a spreadsheet.
Yep.
And really, if the deal pencils, I was having this conversation with somebody this morning, like if the deal pencils, of course, you should weigh that option of paying the premium for those dollars, especially if you're talking about, if you're looking to raise second position debt or equity, whatever it is. If you're truly confident in that and you want to obviously do it responsibly, it makes sense to pay a premium if you're not giving as much upside, to your point. And I've had that conversation. I've been approached by kind of builders around in the area that are looking to scale a little bit more. And a way to do that is typically raising equity or second position debt. And that's the thing that we talk through is like, well, here's the risks and the rewards of each one.
Yeah.
And really for me, one of the things it boils down to is your confidence in that deal and making sure that you do feel confident in that upside and that it's enough that you can commit to, all right, I will pay a premium for a debt type position, knowing that the spread above that is significant. Because if, for instance, the spread above that's thin, maybe you do go equity because then you're, pari passu, or you're sharing in the upside equally, and you don't accidentally eliminate your upside.
Yeah, and that's where it goes back to the thing that I love about the private lending space, and it's again, we would not be sitting here without it. I mean, the gentleman, shout out to David, did our first deal, first acquisition, also got started with you in Maine, and just an all around good guy. Found that deal on Craigslist, and to this day, changed my life. And it was all private, and it was all down the road, and here we go. But what I wanted to go back to on that, you'll notice Mike keeps coming back to the deal. And when you guys are looking at private lending as an option, I think one actionable tip that I think can help everybody who's going to listen to this, because we have we have people who are sophisticated, we have people who are passive, people who are active. Let's say somebody who's a newer borrower, and I always encourage them to go private money, but I always tell them, like, you got to sell yourself. What are some things you look for in a first-time borrower, and maybe some things that you would kind of run for the hills if you saw?
That's a good question. I'll start with like my most global answer, which is I really like lending in my backyard because it allows me to go and meet with somebody face to face.
Yep.
And I think this is a really general answer, but I think that tells a lot. And without getting too specific, you kind of get a feel for how real somebody is, not only in their knowledge, because that's very important, but their ability to work through solutions, to problem solve. And like, you can't work through all these in one conversation oftentimes, but there are certain kind of feelings that you generally get. And why I think I consider myself a handshake guy, because I think there's an importance in that. And I think that's lost in some businesses when you scale, or if you're entering other markets, which in our space, when we're operating in this setting that is a little bit more intimate and we're creating more relationships and it's relational based to allow us to provide a better capital source for our borrowers. Mm-hmm. You really need that relationship to be able to push those limits and get as comfortable as you possibly can while still, covering ourselves and protecting our investors.
I love that. And what is one thing that would really make you hesitant to do a loan with somebody?
If they just clearly don't, actually, here's a good one. If I ask somebody what they can sell the property for, I always immediately ask for 3 numbers on a flip scenario. What are you buying it for? What are you putting into it? And most importantly, what do you think you can sell it for? If they don't know those 3 numbers and specifically what they think they can sell it for, I'm like, man, I mean, especially can you sell it? Because that's where, in my opinion, if in my unsolicited opinion on where you should start analyzing every deal, I think to some extent you should start with what could this thing be worth? Because you can pre-qualify a lot of deals very quickly, and you can get to a no a lot faster and look at more deals and more opportunities if you start there. Because if you try to go the other way, what can I pay? And then what can I value engineer a budget to do everything I need to do to get it to this number? That's where people run into problems, I think.
That is great, because that's going to lead to the next thing I was going to say. The advice that I give everybody, and this is something you can do wherever you're at in your career. And we're working on a potential deal right now, and I'm already doing it. I'm already talking to my takeout lender. So Mike is saying there, and again, I want to emphasize that, is start with the end in mind. Figure out, what is this worth when I'm done? And what is my exit? And what is the backup plan to that desired exit? And then what's the backup plan to that desired exit? So for example, when we go and do a deal, say we're doing a multifamily deal, we are stress testing that deal for the cash out refinance portion the same way a bank is going to underwrite that deal, because that's going to tell us what we can spend. We call it the dirt and the delta. What's the delta between our purchase price and our after repair value? And it has to work for our takeout lenders. We're then shopping that to our takeout lenders to get an idea of, hey, can you give me a debt quote? As you get bigger, they become even more important as you grow. But really, what does this look like, right? What kind of debt? What would this size at? What metrics? What are you lending on right now? Then I look at, hey, give me a CMA, give me a broker's opinion of value. If I go to sell this, what is the question I always love to ask, because this is where you know if a broker bullshitting you or not. They'll give you some number, and then I'll say, okay, what if I had to fire sell it? What if my note was coming due? I didn't want to do an extension. I wanted to keep going. If you had to fire sell this property and I'm halfway through my business plan, I'm all the way through, what does it look like? These things are probing questions, but what I want to do is when I go to do the acquisition, I already want to have my exit lined up, and then I want to back up on my exit. And that's kind of the way we approach it, the way we facilitate it, and we kind of think through everything. And it sounds like as a lender, you want to think about it the same way.
Yeah, I would say if there's one other thing that is incredibly, that's a differentiator. If somebody is expressing that they've thought through their exit or exits, and verbalizing that and getting in front of it, that's a huge green flag for me, because there's a level that indicates sophistication and just a proactiveness that not everybody has. And I think the general takeaway there is you're giving yourself optionality. And I think in really any type of deal that you're doing, if you're giving yourself that optionality at any point in the deal, then you're good. Yep. Because you have multiple exits, you have multiple pivots that you could potentially do if things go sideways, or if not. Yep. You just you simply have options.
Yep. And that's also important to understand too, because what you need to know is, and that's what I try to explain to people. I think lenders think, at least on all the ones I talk to, I think everyone thinks the lenders like Scrooge McDuck, right? They want all the gold. No, in reality,
I think somebody's called me Scrooge McDuck before.
But probably, I can just picture you now like the little fucking gold pit, diving in.
We don't have to get into that.
But DuckTales over here. I remember that. Go back. Shout out to the 90s. But on that note, where that goes and where that gets important, what I actually tell people, especially when I'm coaching them, I go, listen, what lenders are going to want to know is, when can they expect their money back? How are they protected? And that is a very important thing for them to understand, hey, listen, this is my date. This is realistic. And in fact, I actually just got some great advice from this guy. We've I hope the streak continues. We've never missed a payment. We've never been late on any loan. We've never done anything. That's how we operate. I guess that's not the case for all borrowers. But I just got some advice from another really, really good investor. And he said this to me. He goes, listen, call your lenders up. You have a relationship with them. If you think you're going to be late, if you think something changed, give them a heads up. Don't let that stress into your body.
Man,
I had never heard that. I am always dreading everything like there's this ticking time bomb. Does that go a long way?
It goes a way longer way than you'd think. And I'll just give an example. We have the luxury of discretion over the money that we lend, right? Which means if you get to an instance where somebody gets in a bind, there might be an instance where it's justified and you understand it. And if we're underwritten really well, there might be solutions. We're not always going to resort to bringing down the hammer. However, if somebody doesn't communicate at all and isn't willing to work with us to help them, then it makes it a lot more challenging, right? So the communication ahead of time, I am incredibly receptive to and very appreciative of, because
great tip.
At the very least, we can start, if there's a ton of equity in the deal, especially towards the tail end, maybe we rewrite the loan, maybe we modify the loan. If there's a ton of equity, to say, hey, maybe we just work in an interest reserve, or we can get creative. And so that's an advantage of working with a true private lender, but you have to use it wisely in that over communicate. I'm a huge fan of over communicating. I don't think it's possible to over communicate, but
people are gonna start calling you and emailing you constantly.
Which
all of your borrowers, just watch out now.
Yeah, but I think communication is key in so many aspects of not only lending, but life.
I agree. And I'd also say another thing that I think goes a long way, and I do this all the time. I'm just thinking of all these tips now. We've never put this out. This is great because there's so many actionable tips, and I don't think this one gets talked about enough. I try to touch base with every one of my lenders at least once a month.
Great.
I nature those relationships. These are teammates. They're not people you only call a week before closing and something needs to happen. I literally touch base with every single, and I have a lot at this point. I make it a point to touch base with everyone in that ecosystem at least once a month. And the conversations usually go something like this. Hey, this is what I'm seeing in the market. This is what we're working on. What are you kind of seeing? Where do you think banks are at? You seeing any distress on the horizon? Is there a lot of dry powder on the sidelines? A lot of people flowing capital again? What do you got? And then really you get to know them too. You get the personal touch, but it's really like, it's funny because my private money guys always like to hear about my takeout lenders, my perm debt guys, which I just heard because my Boston accent. I'm saying debt, D-E-B-T. My wife says I say deck. I'm like, no, it's debt. So she was confused.
I didn't catch that.
Her and Ian Bishop giving me shit about the way I say that. Tag him on this video. But anyways, and then my loan brokers always want to know, what are your private guys saying?
Yeah.
What are they seeing?
It's true.
So you really are in this unique position when you're an investor working in both spaces. I mean, I got a message today from a guy. I'm going to connect him with you. I'm connecting with David, Zach, everyone down the line, because I don't know what his deal is yet. But this small world, guy's a rock star in the industry. I won't put his name out there because I don't know if he wants to know it on this deal or not. But he just in one of our Slack channels, one of my big mastermind, goes, hey, does anyone have a great hard money guy? I have a quick, small portfolio of 9 single-family homes I need to close. Messaged him. He already texted me. Well, because now my network, every one of those guys are going to appreciate getting that referral, right? These are relationships. You don't just call them when you need something. You nurture it, you water it. And then these people, I mean, sometimes I call one of my guys, sometimes they're more upset when something goes sideways than I am. Like they got your back.
Yeah.
You know what I mean?
And I'd say from my perspective, like if I have somebody that I'm speaking with regularly, and I make an effort to speak with my borrowers as regularly as I can for the relational piece, but there's 2 things that come to mind. It's the educational piece on the two-way street, like the idea of like, hey, what's the deal with takeouts right now? Because I'm really not as in tune with that world on a regular basis, aside from getting taken out by these lenders. So getting the real time from like people like yourself that are actually dealing with it and in going through the kind of details and the nuance of it that can give those kind of more in-depth explanations, super educational for me. And that allows me to be a better resource for my borrowers, 1. And then 2, if you're somebody super active like yourself, that helps me help you. If you're talking to me once a month, there's a good chance I know just about everything you've got going on at some level. And then if deal comes up, it's like, oh, we can take this property over here and get creative in this way. And it's not start from square one, send me everything you got. And so that's another advantage, I would say. That's huge. All right, Mike, before we get out of here, where can people get in touch with you and learn more about what you got going on? I'll give my cell phone, 207-838-5987. Text or call. I always welcome a phone call. And then our company is Lukrom, Lukrom. So we have a website, lukrom.com, and then our lending specific website. And the lukrom.com is a little bit more geared toward investors into our fund, which we're always welcoming of, happy to talk about. And then lukromlending.com is a little bit more targeted towards our borrowers. There's an intake form for any new loan requests and all that good stuff. I'm also on LinkedIn and Instagram, Michael Susi 20.
I love it. And again, guys, I'd encourage you to reach out. I'm just so proud of seeing the growth, but it's also your resource now for other people coming in the space. So thank you all for watching another episode of the Michael Ketchen Show. And as always, bet on yourself.